All right, good evening, everybody. You're welcome to class again. So this evening we'll be looking at the first chapter in the financial management syllabus, which is financial management function and environment. Financial management function and environment. That aspect of the syllabus is weighting 10% out of 100%. So 10% is the weight of this aspect of the syllabus. Yes, the fact that it weighs 10% is what we can know. So that when we see questions on these aspects of the syllabus, we should quickly acquire the whole mark attached to it without any delay. And that is why I have divided these aspects of the syllabus that every one of us should look into it. Then we'll come up with a presentation about these aspects of the syllabus because it is purely theoretical. So what you say will remain with you, and you can easily recall it when you are faced with such questions in the examination hall. So when we talk about financial management, just like a background, when we talk about financial management, these are two words put together: financial management, from the word finance, from the word management. Financial management involves managing all of a company's assets and liabilities. It does not end there. It includes monitoring and controlling operational financing items such as expenditures, revenues, accounts receivable, accounts payable, cash flow, and profitability. And why analyzing all this? Because all these put together will add value to the company, will increase the value of the company. The main reason why organization exists is to make profit. And in making profits, there should be value addition to the owners of the company, that is the shareholders. So by the time I'm a shareholder in Zenith Bank and my dividend remains constant over time, I will not be happy. So there should always be value addition year in, year out. So financial management also involves risk assessment and risk management. So before you make a decision, before you proffer solution to a financial issue in an organization that you will head or you are currently heading, maybe you are the head of finance in that organization, before you give decision, you proffer decision to issues, you management involves risk assessment, risk management, and it also entails evaluating the potential financial exposure a company incurs by making capital expenditures or by instituting certain workplace policies. So when we talk about financial management, is all about going back to the concept of CSME. Yes, CSME. That is looking at what is strategy, which is also in PM, which is strategy, because financial management will help in an organization to achieve its long-term objective. And for you to achieve your long-term objective, you must have a strategy. So when we talk about strategy, this is the determination of the basic long-term goals and objective of an organization, and the adoption of courses of action and the allocation of resources necessary for carrying out these goals. Now, there are various persons that have come up with a definition. We have Chandler, If you go back to your CSME, you'll see that definition. So strategy is a pattern of activities that seeks to achieve the objective of the organization, and it adapts a scope, resources, and operation to environmental changes in the long term. So this financial management, what it entails, it involves how you can manage the resource of an organization effectively and efficiently in order for the overall goal and objective of the organization to be achieved. So when we talk about the nature and purpose of financial management, there are various forms of businesses, and there are various reasons why they exist. We have NGOs, we have non-profit organizations, we have organizations that are out to make profit. So why are you existing? Are you working in to achieve your stated objective, or you are derailing from it? And we have public sector organizations. They are just out to provide essential services to the masses. Yes. At affordable rates. So all these are what financial management is, of we computing activities that has to do with finance, such as when you have to make investment in an organization, what are the appraisal techniques you can adopt in order to make a meaningful investment. So you don't just make investment like that because you have the resources. You make investment based on verifiable facts, and you make investment based on what will give you the best return. So these are what financial management entails. So it's all about how an organization plans, raises, uses, and controls money to achieve its objective, and basically making sure that funds are used to maximize value. That is financial management. And the objective of financial management primarily is wealth maximization. We have other ones such as profit maximization, liquidity, solvency, growth and sustainability, and so on and so forth. So due to time factor, I will give room for the group one to do a talk, a presentation on these aspects of the syllabus, the nature and purpose of financial management. They are expected to explain what the nature and purpose of financial management is, explain the relationship between financial management and each of financial accounting and management accounting, identify and describe various financial objectives, including stakeholder value creation, shareholder wealth maximization, profit maximization, earnings per share. So these are what they will talk about. So I don't know, for group one, who is the presenter?
I'm presenting, sir.
All right, so let me share your slide now. So your slide is on, man.
Good afternoon. Good evening, everyone.
Good evening, ma'am.
Good evening. Okay, so group one, we are presenting for the nature of sorry, the nature and purpose of financial management. Next slide, please. Financial management is concerned with planning, organizing, directing, and controlling financial activities of an organization. It focuses on efficient use of funds, acquisition of funds at the lowest cost, proper allocation of financial resources. This applies to business, non-profit organization, and public entities. So the nature of financial management: decision-oriented discipline focuses on making sound financial decisions. Continuous process. It operates throughout the life of a business, and it emphasizes planning and forecasting. And it's risk focused. This is supposed to be on details with uncertainty and financial risk, and link with economic and accounting statistics and management. The key areas of financial management: we have the investment decision, where to invest our funds, like capital budgeting. Then we have financial decision, sources of fund, equity or capital or debt, source of fund. Then we have dividend decision, distribution of profit to shareholders. Then working capital management, managing short-term assets and liability. The purpose of financial management: to ensure adequate availability of funds, to ensure optimal utilization of financial resources, and to maximize organization value, to maintain financial stability and liquidity, to support long-term growth and sustainability. The relationship between financial management and financial accounting. So financial accounting, as we all know, dwell in past financial transactions, and financial accounting focuses on income statement, balance sheet, and cash flow statement. Our financial overview reflects a robust and resilient fiscal performance. Key indicators shows consistent revenue growth over the past quarter, attributable to the strategic cost of management and successful marketing. The relationship between financial management and financial accounting. Financial management uses financial accounting data for decision making, while financial accounting management accounting focuses on cost analysis, budget, and performance reports. The relationship between them is financial management relies on financial accounting for planning, control, decision making. Both serves as internal management needs. Financial objective of a firm. The major financial objective of a firm includes stakeholder value creations, shareholders wealth maximization, profit maximization, earning per shares growth. This objective guide includes financial decision making. Stakeholder value creation. The stakeholder value creations include shareholders, employee, customers, suppliers, government, and society. The objective: balance the interests of all stakeholders, ensure long-term sustainability of the business. Example, like for instance, fair wage to employee, quality product for customers, and ethical and environmental responsibility to the public. The primary objective of modern financial management focuses on maximizing the market value of shares, taking into account the risks, the return, and the timing of cash flow. The important reflect overall performance of the firm and align management decision with owners' interests. Profit maximization. The traditional objective of financial management focuses on interesting total profit, short-term earning. Limitation: ignore risks and uncertainties, then ignore timings of profit and may lead to short-term decision making. Earning per share growth. Earning per share is equal to the net profit divided by number of outstanding shares. It indicates the profitability per share. The objective: increase earning per share over time and improve shareholders' confidence. Then the limitation: earning per share growth may not reflect with value creation and can be influenced by accounting policies. Comparison of financial objectives. So we have stakeholder value, those are the objectives, shareholders' wealth, profit maximization, and earning per share growth. The focus is, for shareholders' value, it focuses on all stakeholders, and the time is a long time objective, and the limitation is complex to balance. Then the shareholder wealth, we have market value, is a long time and market fluctuation. Profit maximization, we have the focus on total profits, and the time horizon is short time, and it ignores the risk involved. Then the earning per share growth, we have per share profit and medium term, and we have the accounting effects. In conclusion, financial management plays a critical role in business success. It integrates planning, decision making, and control. Modern financial management emphasizes on shareholder wealth maximization and long-term sustainability. Effective management, financial management benefits both the organization and the society. Thank you.
All right. Thank you, Madam Victoria. Yes. But you're expected to explain. You didn't explain. You just gave me back what you put down. Yes. Expected to open my eyes to certain things. Yes. That's the essence of the presentation. Yes. So I'll ask some questions. So maybe through those questions, you'll be able to shed more light on certain areas that you talked about. So in simple terms, can you just give, you might not be the only person, your group members can also respond to my questions. Yes, that's, the question is this, just in 2 sentences, can you just give us the relationship between financial management and financial accounting? What is the relationship between financial management and management accounting? What is their meeting point? Yes. Anybody can respond. You want to tell us the relationship between financial management, financial accounting, and financial, yes, relationship between financial management and financial accounting.
Okay, they use for financial focus, they use financial data. Hello?
I can hear you now.
They use financial details. That both financial FM, MA, and financial accounting uses financial details to arrive at their decision making. And also they use accounting data in making.
Right. Thank you, ma'am. Yes. So in order to buttress what she has said, financial accounting
Can I contribute, sir?
All right, fine. I'm trying to mute Madam Choma. All right. Yes, you can contribute.
The relationship between financial management and financial accounting, they both use ratio analysis to
Okay.
make reports. This is one of the similarities. Then they also use long-term investment appraisal. Is also an aspect where both management accounting and financial accounting, they use they use the same, they use this, sorry, they use both of them use investment appraisal to appraise to give long-term, in terms of long-term decision making. Then another point is that management accounting provides information on inventory control, receivables, and other information. Then financial management is concerned with the efficient management of working capital. And we know working capital need those information too. So these are areas where they have similarities.
All right. Thank you very much, ma'am. Yes. Thank you, everybody. So, yes, Madam Choma, I want to say something. You can unmute yourself.
Okay, what I wanted to say is that the relationship between financial accounting and management accounting, they prepare they prepare financial statements for shareholders and external users so as to help them with their planning and controlling of organization resources and in decision making.
All right. Thank you very much.
Okay, sorry, just add something.
All right.
So for management accounting provides the numbers and analysis, while the financial management uses these insights to make strategic decisions.
Right. That's very good. Yes. So the relationship between financial management in line with financial accounting, first, is that financial accounting is concerned with what? The systematic recording and reporting of past financial transactions through what? Financial statements. While financial management depends on what? Depends on this statement to evaluate the financial position, performance, liquidity, and solvency of the organization. So in simple terms, I would say that financial accounting provides reliable historical data, while financial management analyzes and uses this information for planning, control, and strategic decision making. So you might wonder, why is this coming up? There can be a scenario question, yes, that's based on what you've computed in the exams. What are the benefits, or what is the relationship of this your information to the financial manager? So some of these highlights, some of these concepts should begin to come to your head. Yes. So because it's not everything. Sometimes you will read in the book. Yes, some of these things need you to think outside the box to answer those questions. So that is why we're coming up with this. So the relationship between financial management and management accounting. The management accounting focus on what? On the preparation of internal and future-oriented information, such as what? Budget, cost analysis, forecast, and variance reports. Yes, that is management accounting. You know, management accounting is what metamorphosed to performance management. So financial management uses this information to formulate financial plans and appraise investment and manage what? Working capital and control cost. So management accounting acts as a decision support system to financial management. So that is the relationship between financial management and financial accounting, the relationship between financial management and management accounting. Let's come up with another question. let's see another way that we can respond to question again. This aspect, let me ask these aspects. Yes, this is very important. It's one of the core aspects of financial management. Yes, because financial management plays a central role in achieving the objective of an organization. So I want to ask, I want I want us to explain the following financial objectives. You know, you highlighted certain financial objectives. Yes. And then one of it is stakeholder value creation and shareholder wealth maximization. When we talk about stakeholder value creation, shareholder wealth maximization, profit maximization, earning per share, what are we talking about? So what is stakeholder value creation? Stakeholder value creation. We need to know. We need to know what is shareholder wealth maximization. We need to know what is profit maximization.
Stakeholder value creation is about delivering benefits to everyone that has invested in that business. So the key stakeholders is the key stakeholders are the shareholders. The shareholders seek profits and growth on the business, while the customer wants value for the money and quality of goods and products being delivered, while employee needs fair pay, growth, and a good work environment. And suppliers and partners are looking for timely payments and long-term relationship. And the community or society expects a social responsibility and a minimal environmental impact. Creating value means one is innovate, that we develop a good product and services that meet needs. And the second one is delivering a good quality that ensure good services exceed customers' expectation. And the public expects that we are transparent so that we can build trust. I'm talking about the stakeholders, that's the community and the society. And then creating value also requires that we invest in people. That is our employees, we develop in them and support our community. And then sustainability, balance profits with social and environmental responsibilities. So it matters. The reason why this is important, it also enhances the company's reputations and brand loyalty, and it drives a long-term success and growth.
All right, thank you very much. It's a very beautiful response. Yes. So talking about stakeholders value creation. If you're in this class, you don't know who stakeholders are, it means you need to revisit, what is it called? Your CSME. Yeah, don't mind me, I'm just referring to that. That is very important. Stakeholders are those that have a stake in an organization. Yes. So just as she has said, she has given a very beautiful response. Yes, which I'm very glad about. So when you talk about stakeholder value creation refers to the objective of creating value for all parties. Everybody that have a stake in the organization, I should get a value. Yes, the environment, the community where the company, the organization is situated should enjoy what we call the corporate social responsibility. In some organization release harmful substances that pollutes the environment, that pollutes the water of that particular community, that render the land unfit for agriculture. So what is the return the community will get? So all this. So stakeholder value creation refers to the objective of creating value for all parties that is affected by an organization. So not only shareholders now, not only shareholders, but everyone that have a stake, that has an interest. So these stakeholders, just as you have said, can include the employees, the customers, suppliers, even governments, creditors, and the community as a whole. So the point is this: it involves balancing their interest, because you as a worker, you want higher wage. The shareholder, they want higher dividend. So there will be a point, there should be a strike, a place whereby we strike a balance to see that we satisfy everyone that have a stake in the organization. So this stakeholder value creation involves balancing the interests of the of the stakeholders, that is good working conditions for the employees, quality products for the customers, ethical practices that will benefit the employees and the community where they operate, and likewise the environmental responsibility, which in turn will support the long-term sustainability of the organization. When all these are not being met, it means anything can happen to the organization. The community can ask the organization to move out of their environment. And shareholder wealth maximization is the objective of increasing the market value of shareholders' investment in the company. Yes. So as you make profits and you plow back returns into your business, you should use what you've retained to diversify the organization objective, so that as the organization grew, more returns will accrue to the shareholders. But by the time the shareholders' wealth maximization is stagnant, time will come, there will be liquidation, and the market value of that organization share will decline in the market. It is when you are doing good that people will want to patronize the organization and invest in the organization. So profit maximization, this aims at achieving the highest possible accounting profit within a given period. So that is the concept of profit maximization. And the earning per share refers to the objective of increasing the earnings attributable to each ordinary share over time. That is why it is called earning per share. Earning per share. So as a shareholder, you desire to get more. Oliver Twist gets more every year. You understand? So that is that about that. Any question from the house to this group? If there's something you need clarification about as far as this aspect is concerned. Any question? All right. Maybe you don't want to ask questions, so that when it is your turn, they will not ask you. That is how we do arrange it those days in school. You ask me questions now. When this is your turn, I'll also ask you. But the point is, if you have a question, please do ask. And the essence of this is for us to get knowledge and be very sound in preparing for the exams. So thank you very much, Group 1. Thank you, Madam Victoria, for the good work. A very nice one. I appreciate. So I will send this slide to the group so that every one of us can have access to it. So now we'll move to the next group, which is Group 2. I don't know if Madam Victoria Oni, are you on the platform, ma?
Yes, sir.
All right, thank you. So, yeah, Group 2, ma, right?
Yes, sir.
All right, so for Group 2, they are expected to tell us about corporate objective and the influence of stakeholders. Corporate objective and the influence of stakeholders. And under this, they are to discuss the key stakeholders of an organization and advise on their interests and assess possible conflict between the stakeholder objective. I think we've even talked about some of this. Evaluate management's role in managing stakeholders' objective and assess the various methods of achieving stakeholders' objective, and advise on various ways of evaluating the corporate objective, including ratio analysis and total shareholders' return changes. All right, Ma. Over to you, Ma.
Thank you, sir. Good evening, everyone. We'll be talking about stakeholders' objectives. Stakeholders and their objectives. Who are the stakeholders? The stakeholder refers to everyone with a vested interest in activities or performance of the company. What do we mean by that? Is that the people, individual or group of people that have interest in what the company does, and which they might be able to influence the corporate objectives of the company. And we have the main categories of the stakeholders in the company, the key stakeholders. We have the shareholders. The shareholders, their aim is to obtain a suitable return from their investment. That is, they want to maximize their wealth. And so some shareholders are long-time investors. So, and we also have, why there are other shareholders that may be interested in short-term investment, hoping for quick capital gain and high short-term profit and dividends. We also have another key stakeholders, the director and the senior manager. These are they are led by its board of directors and the senior executive management. Their interest in this in the company is the income, the profit, the good condition, their personal wealth, their salaries or wages. That is their interest in the company. Then we have other employees. The other employees' interest is their salaries and wages, the job security, and the career prospects, unlike the directors and the senior executives. So other employees might have less influence on what the company does, unless they have a strong trade union. Then we have the lenders. The lenders could be the financial institutions. So when company borrows money, the lenders they are the stakeholders. So they could be bank or the financial institution. And their main concern is to protect their interest. That is to protect their investment. That is, if the company is heavily in debt, credit risk might be a problem. Then the lenders might be concerned about the inability of the company to meet its interest and principal repayment obligation. That is for the lenders. Then the government, their impact in the company. The government their interest is to regulate the activities of the company. And also they are to generate income through taxation. The company also help the employers, as in to get full employment. The aims of the government might be able to achieve, the aims of the government is that they'll be able to achieve full employment from the companies. Then some of the companies are major suppliers of the government. Then we have another key stakeholder is the customers. They are only interested in their goods and services. Is it worthwhile? Are they in good condition? And they're able to influence to what the company does because they buy from the company. Then the supplier, they supply to the company, and this might influence some of their actions in the company. Then the society as a whole. The society as a whole is there, so that the business a company might need to consider the concern of society, the business ethics, human rights, the protection of the environment. They want them to avoid pollution in the environment. So the companies might need to consider all this for their own reputation. So, and the ability of the stakeholders to influence what the company does depends to a large extent. The extent to which their interests can be accommodated and do not conflict with each other. Then the power of each group of stakeholders is to determine or influence the company's objectives and strategies. Then the next question is possible conflicts between stakeholder objectives. Then we have conflict between the stakeholders' objective. The conflict could be the interests of stakeholder group. They are satisfied partially but not in full. This conflict could be like agency conflict. Agency theory. Let me just go to agency theory. To talk about the conflict, we have the agent in the organization or the company. These are the relationship as a form of contract between the company's owners and the managers. So this agency theory was developed by Jensen and Merklin in 1976. You define the agency relationship as a form of contract between a company's owner and its manager. So they have to sign the contract. So the manager is to manage the company on their behalf. As a part of this arrangement, the owner must delegate decision-making authority to the management. Then their conflict is moral hazard. The manager that has interest in receiving benefit from his or her position as a manager, they want to receive special benefits, such as official car, lunches, attendance at sponsored events, and so on. Then they have effort level. the managers, being that they are not the owners of the business, the effect they lack, there is a lack of effort, and this lack of effort could lower their profit and lower share price. So, meaning that they are not the owner of the business, they are an agent for someone. So they have less effort to make in the company. Then we have the annual retention. The remuneration of the directors and senior managers is often related to the size of the company rather than its profit. So this gives manager an incentive to grow the company, increase the sales turnover and assets, rather than increase the returns of the company shareholders. Managers are more likely want to reinvest, they want to plow back the profit in order to make the company more bigger, rather than paying out the profit as dividend. So instead of paying the profit as dividend to the shareholders, they want to plow back the profit, and for their own interest, just to have a reputation in order to make the company bigger. Then in case of risk aversion, they don't want to take higher risk, and higher risks attain, we get higher return. So the management might be risk averse. They will be reluctant to invest in higher risk projects. In contrast, the shareholder might want a company to take a bigger risk if the expected returns are sufficiently high. But the managers, they want to avoid the risk, because maybe in the time horizon, maybe they have a few years to spend in that company. So they might want to venture into short-term investment so that they can get their return for their own personal interest. They will have some agency costs. The agency cost could be in three ways. The cost of monitoring. That is, they will have to make sure that they monitor the audited accounts. They have to present the annual reports, the audited account to the shareholder. They have to set out financial performance and position of the company. Then another agency cost is opportunity cost. Opportunity cost in times like the shareholder arise when the manager take decision. They are not in the best interest of the shareholder, but they are in the interest of the manager. So we have opportunity cost. So take for example, agency costs arise when the company's director decides to acquire new subsidiary and pay more for the acquisition than it's worth. The manager gains personally from the enhanced status of managing the larger group of companies. So the cost of shareholder comes from the fall in share price that would result from paying too much from the acquisition. Then the third aspect has to do with the cost that might be incurred to provide incentives to manager to act in the best interest of the shareholder. We call it a bonding cost. This bonding cost has to do with the remuneration package for the senior executive. Then we have the next one is how do we assess assessing the various methods of achieving stakeholder objective. What are the various methods? We have two methods of assessing the stakeholder objectives. Number one is the regulatory requirements as opposed to achieving stakeholder. We have corporate governance. That is the way a company managed on behalf of its owner by the board of directors. So it is more extensive approach to reduce agency problem, trying to ensure that companies are governed in the best interest of the shareholder. What are those elements of corporate governance? We have the board of directors, we have the remuneration and management reward scheme, we have the board of directors, the remuneration for directors, internal control and risk management, external auditors. Then we have the communication between the company and the shareholder. The steps taken by corporate governance, we have the board responsibility. As a board member, the responsibility is about the strategic investment of the board as a whole. The essence of this is to ensure that major decisions are taken by all directors, not just executive management. We also have board composition. The position of the chairman and the CEO should not be held by the same individual, because if it is held by the same individual, the individual will have influence, excessive influence in that company. So therefore, the position of the chairman and the executive officer should be held by a separate individual. Then we have at least the half of the board, excluding the chairman, should be independent, non-executive director. So we should have like external director that should not, that they are not internal part of the directors. They should have non-executive board. And this to ensure that the individual in the board who do not have a conflict of interest will work in the best interest of the shareholder. We have board committees. This insists that there should be at least 3 committees in the board, which we have nomination committee to appoint the director. We have audit committee, we liaise with external auditor. Then we have the remuneration committee. They are to negotiate the remuneration of the individual directors. Then the external auditors, they are to comment the audit fee, review auditors' performance to reduce the influence of the executive director. You know, the executive director, they have influence on the internal auditor. So the essence of the external auditor is that they have to review the audit fee, review the auditor's performance in order to reduce that influence of the executive directors on the external auditor. And we have the stock exchange listing practice. This to ensure that public companies are managed in best interest of the shareholder and the agency problem will be reduced. These include the financial statement that has to be published regularly. Then, whether in quarterly or in annually, the company must prepare and submit their quarterly report or annual report to the shareholders. Then this report must be submitted within the time frame, or else they face penalties. Then number 2 is, we talk about number 1 is corporate governance. Number 2 is the incentive scheme, the management reward scheme. And the main objective of the company should be a financial objective. But there are different stakeholders group with an interest in the company. So this raises the question, can the agency problem be reduced? Can the manager be persuaded to focus on the returns to shareholders and the main objective of the company? So, but the management remuneration has to do with scheme. Management scheme has to do with the remuneration incentive scheme. That is the reward scheme that links to profit, earnings, the shareholder return. The incentive of the management. So it has to do with remuneration package for the senior manager, either through a basic salary, the annual performance incentive. That is, they gave them a target that if you can meet up this also target, there will be an incentive. So these are an annual reward, which are usually in the form of cash bonus. Then we have long-term incentive. The long-term incentive has to do with target. It's a long-term incentive because they have to provide in the form of share award or share option. So when they were able to meet up the target, as they will give share award or share options to the executive. And what is share award? Share award has to do with when a company purchases a quantity, purchase a share in its own name. Now award this share to the executive directors and other senior managers. Then share option has to do with when option is given to the holder, to the right to purchase new share in the company on or after a specified date in the future. So that is share option. So what are the advice on various ways of evaluating the achievement of this corporate financial objective? Number 1 is ratio analysis. So when we're talking about ratio analysis, we talk about the financial ratio, which are the liquidity ratio, profitability ratio, and so on. So this financial ratio has to measure the comparison over a number of years. And so they can be used to make comparison over time and to identify changes or trend. Then there will be comparison with the similar ratio of other. Take, for example, when you're talking about a profitability ratio, which has to do with the return on capital, that is profit before interest over share capital. So we can be able to compare the two, the one you make previous year and the present year. We compare, is company really doing well? Are they really dear? Are they buoyant enough? Can they meet up with their profitability issue like that? Then we have total share return changes, which has to do with the TSR, total shareholder return, which is expressed as a percentage of the value of the share at the beginning of the period. So the total return consists of the dividend payment plus the increase in the share price during the period minus the fall in the share price. Thank you, sir.
All right, thank you very, very much for that beautiful presentation. Yes, well done. At least with this, you've learned something. Yes, I will not allow you to go. I'll ask some questions. So every other person can also respond. Yes, it must not be the person that have done the presentation. Yes, I have the following questions to ask based on your presentation, ma'am. I want to come up with a scenario question in this way. Let me say that a listed company has recently experienced disagreement. Yeah, just follow my statement. A listed company has recently experienced disagreement between shareholders, management, and employees regarding performance target and reward system. So my question now is this: how can we identify the key stakeholders involved and what are their interests? The other part of this is, can we assess the conflict of interest that may arise among these stakeholders? How can we assess it? How can we assess this conflict of interest? And another point is this: how can the management address this conflict using the principle of agency theory? How can the management address this conflict using the principle of agency theory? Now, more so, still on your presentation, let me ask, how can you advise this company on suitable methods for evaluating whether its corporate objectives are being achieved? Yes. So as an organization, how can you evaluate yourself to know if your corporate objective is being achieved? Because your corporate objective is also a target. So how can you assess yourself if you're actually meeting up with your corporate objective? Hope you get my question, ma, and every other person.
Yes, sir. You asked
Yes, so
many
you can
questions.
respond. Yes, many questions, ma. So you can just give brief talk about any of them. Fine.
Okay. You talk about agency conflict between. How can we know the conflict between the different stakeholders? You talk about that.
Yeah. How can we identify the key stakeholders involved and what are their interests? Yes, in the organization. That is one.
The key stakeholder involved in the company. There's no how the company will have without having the stakeholder. Someone raised they raise the capital through some people. Though the key stakeholder, they are shareholders, because either they raise capital through equity finance or through debt finance. How do I say that? So the major key stakeholders, we have the shareholders, and they are about how to maximize their profit to get their dividend.
Very good.
Then the government too. There's no company that the government will not regulate.
Very
They
well.
will regulate their tax liability,
Very good.
because the government, they might want to receive a tax on companies' profits.
Yes.
So they want to minimize tax liability, because there are some companies that might want to go through tax avoidance, want to avoid tax. So the government will have to minimize it to check on them. So they are regulators.
Very,
We can identify them as regulators in the company.
very good.
So we also have the other regulators could be on the suppliers. At least the company could be whether in goods or services. They are involved in either goods or services. The supplier or the customer. If they are into buying and selling, some people are buying those goods. What are the worthwhile of those goods? Are they in good shape? Are they well branded? So the customer to also have influence. They are also stakeholders in the company. Am I
Yes.
able to?
Very good, man. Very good. Yes.
Then
So
even the
the
society. What of the preservation of natural resources to
yeah,
avoid pollution?
yes, yes, it is very good. Yes. So on the issue of conflict of interest among the stakeholders,
Yes, sir.
yes, that's on the issue of conflict of interest, that's how can we assess the conflict of interest that may arise among these stakeholders, among these stakeholders. For
Okay.
example, yes, yes, speak on, let me get
Go on,
your
sir. For example, go on, sir.
okay, you know, these stakeholders, we say we have shareholders and management.
Yes,
So
sir.
there can be conflict between the shareholder and the management, isn't it?
Yes, sir.
There can be
Yes,
conflict between the shareholder and the employees. There can be
yes, sir.
conflict between the shareholder and the creditors. There can be
Yes, sir.
conflict between the company and the society. So when there is conflict between the shareholders and the management, it means managers may pursue their personal benefit. You understand? They want higher pay.
Yes,
They want prestige. They want fine building, empire, rather than
yes,
maximizing what the shareholders want. The shareholders
yes,
want what? Shareholders' wealth maximization. They want increase in their wealth. But to me, as a manager, what do I want? Increase in my pay. So
yes,
my own interest is different from that of the shareholder. So conflicts can arise. Do you get that, man?
yes, sir.
Now, in the
So how
relation, okay, right on, man.
go on, sir?
So in relation to shareholder and employee, shareholder and employee. Now, as an as a shareholder, I might want cost reduction. If you are coming to me with a budget that for us to produce a unit of a product, we need so amount based on your procurement survey, market survey. I would say, as a shareholder, because I'm eyeing higher profit, I would say reduce the cost, because the higher the cost, the lower the profit. But
Yes,
when the cost is low, I will be able to achieve a higher profit. So cost reduction to increase profit may lead to lower wages or job losses. Yes. So, for example, if I should reduce the cost of a good, I as a shareholder, I should be expecting that I will get profits, more profits in return. And also, the employee might be eyeing higher wage, likewise, might be eyeing higher wage. So there can be conflicts because you as an employer, especially if you're in the finance aspect, you are looking at the profit. These people are making also profits and they're giving me peanuts as salary. That can weaken your morale. That can lower your morale. And you might not want to give your best to the organization. So these are ways in which conflict can arise between shareholder and employee. And also shareholder and creditor, likewise, there can be conflicts because shareholder may prefer a higher risk project to increase returns, while the creditors may prefer low risk activities so that the loans can be protected. So whenever you are asked question in this way, you look at the shareholders, this stakeholder against this stakeholder. What can be the conflict that can arise between them? This stakeholder against this stakeholder. What can be the conflict that can arise between them? So
okay.
these are some of the the thing you can mention when asked such question.
Sir.
I also ask the question that what is the management? How can the management address this conflict using agency theory? How can management address these conflicts? Can you try? Can you give a try? Anybody can give a try. Some of us who are into this practically, you can share your practical experience. So, how can management address this conflict using agency theory?
Well, the
Anybody?
managers,
Yes,
let me
yes.
try. The managers can address this for the shareholders, meaning that they are the they are to their aim is to maximize their profit. They should just try to maybe they list their shares on stock exchange, as in engage in equity finance
Okay,
or debt capital
okay,
they could do in equity finance to maximize their wealth. Why that of the management, they try to invest on short-term investment so that they'll be able to get little profit to increase the salary and wages for the workers.
okay.
I don't know if I'm making points.
Even when I'm marking your scripts and you write all these things, the fact that you put down something, at least I can give you 2 marks.
Mr. Thomas, can I add something?
Yes, very well, ma'am.
Okay. Clear communication, that regular communication between the managers and the shareholders, and then
Yes.
performance-based incentive,
Okay,
and maybe an annual general meeting where these issues are being addressed.
okay. Yes, that is fine. Yes. So the point is, when we talk
Sorry, sir.
about agency, all right, sir.
Okay, I just want to chip in with regards to such when you have such conflicts. One of the strategies you can use to probably mitigate is such conflict is maybe performance-based compensation. As you put in more effort, you get so and so. And also there should be um I think proper auditing, because one person is claiming because of self-interest of managers, they will do anything, cook the books just to make sure that they align everything to their own benefits. So once they know that there is a proper auditing process that is in place, I think that will actually mitigate their excesses.
All right,
So,
that is very fine, sir.
yes.
Very good contribution. Yes, Madam Choma.
Okay, in order to reduce agency problem, incentives should be provided to the management to enable them to take decisions that will benefit shareholders by maximizing the value of their shares.
Yeah, very fine. Yes, every contribution is beautiful. It's fine, and that answers it. Yes, it answers it. And one more thing I want to add is that there should be the organization should embrace ethics, good ethical um, behavior should be encouraged. Yes, within the organization, because when ethics is upheld, it means you are doing what is right. And every stakeholder knows that anything the management is coming up with is always right. There will be less conflict. But when there is always shady deals, window dressing of book of accounts, doctoring of books of accounts, all these will bring up interest, will bring up conflicts in an organization, because the a party, a stakeholder discover that things are not being done right. The community can feel that they are being cheated. Yes, and because the organization is not living up to expectation, they are not even fulfilling their corporate social responsibility. as they've stated before setting up their business in the organization. So all these are things that we can use to address conflicts in an organization. But the main question is, you must know what agency theory is. You know, agency theory explains the relationship between shareholders and what the management. It means it involves principal and agent, principal and agent. So that is the theory, what the theory talks about. So, all right, Madam Alicia.
So, can this also cause conflict, probably as in valuing other stakeholder opinion more than the other? I don't know. I'm just
Yes,
Mm.
when you value other people's opinion, and that opinion you are valuing is you are valuing it based on bias. The opinion, whether it is good or bad, you accept it. It can bring about conflict. But when I give you an opinion, and the opinion is what will move the organization forward, is what will enable us to achieve the objective of the organization, fine, everybody should embrace it. But once an opinion is based on from a biased mind, once an opinion is something that will bring the organization backward, and it is being accepted, others that know where they are going will want to raise their voice, and that can result into conflict. So that is it. I don't know if that answers the question.
Yes, thank you, sir.
Yes, Madam Costly.
Good evening, sir.
Good evening, ma.
I wanted to add a little thing concerning um, conflict
All right,
between what will make that conflict not to really happen is when those stakeholders, that is the management, when they bring them into the company as stakeholders, I think most of them will protect the interests of the company. They will not behave the way they like, because they know if they behave the way they like, they will go for it. That is, it will affect them too, not only the shareholders. That's what I have to say.
all right, that is very good. Mr. Michael. Yes, Mr. Michael, are you there? You're muted.
Yes, I am. Yeah, good evening. Please,
sir.
I just want to get there's an explanation you gave as regards to the agency theory. I didn't
Yeah.
get that explanation very well. I was actually having network challenge here. So please, can you please, uh, rehearse it again so I can understand you vividly well, sir, please. Thank you.
All right, sir. So talking about agency theory, I said that this agency theory, that it shows the relationship that exists between one party and another. And these two parties can be termed the principal and who? The principal and the what? And the agent, right?
And the agent.
Yes, the principal and the agent. So okay, fine. You can tell yourself. So the principal, what the principal does is that the principal delegates decision-making authority to another party, and that party is called the agent. And the agents work for his or her money by acting on behalf of who? The principal. So talking about this agency theory, bringing it down to organization, The shareholders are the principal. And who are the agents? Let me ask, in an organizational setting, who are the agents?
The management.
Very,
The
very good.
management.
Very good. Yes, the management are the agents. That is the directors. They are the agents. So by the time you invest your money as a shareholder, you are sleeping in your house. You gave your money out to those companies because you believe in their management, that they will use your money well. So they are acting on your behalf. They are acting on your behalf. So agency theory is simply the relationship that exists, shows the relationship that exists between the principal and the agent. The principal and the agent. And this theory, what agency theory does is that it recognizes the fact that we are human, there will always be conflict between one party and the other. So this theory tries to address those problems. So the theory recognizes that conflicts may arise because the objective of shareholders and management or managers are not always the same. So the shareholders will aim for wealth maximization. The managers may pursue their own personal goals of trying to get a big house by using your money to do that, to achieve that purpose. And that might result into conflict. So the agency problem occur due to what? Goal conflicts. When my goal and your goal are different, when the goal of the principal and the agent are different, there will be problem. And whereby I'm not getting the appropriate information I need to get, whereby certain information are being hidden. Yes, there's no transparency, conflict can arise. And sometimes I might be a risk lover, and the managers might not be risk lover, they might be risk averse. So whereby there is no balance between our risk appetite, there can be conflicts between both parties. So that is it about agency theory. Agency theory. For those that will be that are doing audits too, this is a reflection to also come. For those that have done CSME over time, they will have seen this likewise. So hope we are fine. Any question, any addition to this presentation before we move to the next group? All right, thank you very much, Ma, and every other persons have contributed to this. More grace to you. Yes.
Amen.
So let's move to the next group, which is group 3. For group 3, yeah, analysis is expected to be based on financial management in not-for-profit organizations. And they're expected to evaluate the various objectives of a not-for-profit organization. They're expected to discuss the ways of measuring achievement of objective in a not-for-profit organization. And more so, they are expected to talk about the economic environment, business, and evaluate the macroeconomic policy targets and illustrate the role of fiscal, monetary, interest rates, and exchange rate policies in achieving macroeconomic policy targets, and assess the influence of government economic policy on decision making in business. So, group 3, who is presenting?
They said I should present, sir.
All right, sir.
So good evening, everyone. My name is Charles Garba. And like the tutor here has said, we will be presenting on financial management in not-for-profit organizations, and also we'll be looking at the economic environment of business. So first off, we try to answer the question skeletally, what's financial management? And here we said financial management refers to that aspect of management which involves planning, controlling, the financial affairs of an organization to ensure that the organization achieves its objectives. Financial management is also primarily focused on managing the organization's finances, that is with regards to raising finance and also ensuring that the finance is efficiently and effectively used, that is utilization of such resources. It also focuses on raising and then the effective allocation of resources. It assists both internal users like financial accounting, which we actually digested earlier, and also external users with regards to management accounting. So let's move forward. Now we're looking at objectives of not-for-profit organizations. What exactly are they driving out, or what exactly do they look out for when it comes to financial management? Here we say the main objectives cuts across about different, categories or classes. But objectives could range from schools and universities where they would want to provide education in an educational system, or when you look at the health sector, where they hinge on healthcare or service delivery, providing special aids also. And this has to do basically with all those CSOs that we all see around who do charities. But most likely, like I said, they're being classified into 4 or 5 different categories. One is the social objectives. Now we look at here, they try to improve the quality of life or address social issues like poverty. Okay. And we have environmental objectives where they try to protect and preserve the natural environment and climate change. Basically, climate change these days, you hear them talking about green energy. That's where we have the autonomous cars, everything going green, no more the use of hydrocarbon. And the third objective here could be or is research and development objectives. They try to conduct research and development in specific fields. Bill Gates is actually driving this aspect very well. He spends so much money in basically the health sector. Okay, if you're conversant with what is going on, he's not just into tech. I think tech was just an inroad for him, but basically R&D is where he actually dwells. So that is a third objective of most of these non-for-profit organizations. Fourthly, we try to look at educational objectives, where they try to provide education and training to individuals and groups. Here, of late, you hear the federal government talking about more education for the girl child. So this is one of the objectives, and it's been driven by most of these CSOs, NGOs. Then number 5 here, we have health objectives. Nigeria is big on this with the advent or the drive towards the primary healthcare system in Nigeria. So health objectives here tries to focus on the improvement of healthcare service delivery. Okay, let's move forward. That's all there is to the objectives. Now let's look at how, since we have now the objectives, how do NGOs try to measure achievements? Now, how can they measure achievement? They do this by using 3 tools or mechanisms. One is setting targets. Okay. Targets can be set for both financial and non-financial performance. All right. They try to, okay, we set this goal for ourselves. How, at the end of the day, they try to measure if that goal has been achieved or not. And they use different mechanisms or tools. And then secondly is using benchmarking. They try to put a peg. This is like, how do I put it now? Let me just use the same word, a benchmark. Okay, we have to actually, if we don't attain this very particular level of success, then it's not it. So benchmarking can be used where comparisons are made with other similar organizations and best practices. All right, they are trying to bring whatever it is they've attained over there, and then they want to bring it here. And God is actually helping us, apart from the corruption that is plaguing the country. But if you want to achieve goals here, you have to use goal settings or setting targets, and then also benchmarking. Thirdly is the use of budgets. Okay, we know when it comes to budget, we try to check what the actual is as against standard. So we set a standard, and then at the end of it, we try to see, did we actually achieve this given the actual results that we get at the end of the day. So budgeting could be used for planning and monitoring expenditures. Now we move to the economic environment of business. And here we try to look at what is the macroeconomics of things. And basically, macroeconomics refers to the economics at a national or international level, okay, as distinct from what we call microeconomics, which has to do with economics of individual firms, industries, and markets. So macroeconomic policy is formulated by countries by a country's government. That's why initially I said by nations and even at international levels. Macroeconomic policy and changes in economic policy and economic conditions can have important consequences for corporate objectives and management decisions. Now, we try to look at some of the major macroeconomic policy targets or objectives. Why do governments set certain policies in place? First off is basically to achieve a sustained real growth in the national economy. Okay, no government wants to just keep moving or driving or thriving blindly. So they try to set like a benchmark. Okay, this is what we hope to achieve at the end of this year. We set goals like in Plateau State, the IRS last year set a goal of 15 billion naira, okay, as internally generated revenue. But I think by December, they made about 34 billion or so, which is not a bad feat to achieve. So secondly, to achieve full employment. Now, one of the critical targets and responsibilities of a government is to reduce its unemployment rates. So every government tries to ensure that her population or citizens who are employable are actually employed, most of them employed. And then thirdly, one of the major targets is what? Price stability or price level stability. In the country from last year, you will all agree with me that the price of foodstuff was so high, but as at December and January this year, I was shocked when I actually priced mudo of beans. It was 600. You understand? And rice too came down. So that is one of the mechanisms, macroeconomic policies government put in place to look at those policies much later. But that is one of the reasons government put in place policies, okay, to achieve price stability. And number 4 is to achieve balance of payments equilibrium. This has to do with international trade, okay, and it has to do with forex, foreign exchange, how much you sell and what you get in return. And any country whose currency is actually devalued, you find out that they tend to earn less, because whatever they get from foreign buyers is actually low, and it makes the produce or the products they're exporting or their exports cheaper to foreign buyers. So government tries to ensure a balance in that so that the country or the economy can thrive. And then fifthly is income redistribution. I think of late we all are aware of the new tax policy. Most people were against it, but we could not help it. They forced it on us. And for me, I think it's good, because you look at, it's not, initially people came with fears actually, that this thing is coming to take or render people poor, okay? But of late, I've heard people saying they've earned more because their take-home pay has increased, because they've actually been pulled out of the quote-unquote tax bracket, okay? Because the government says if you earn anything less than 800,000, you won't be taxed. So for those earning such amounts, they get their full pay. So, and we can see it actually leads to income distribution. Now they tend to go for the high net worth individuals, companies. Those are the people and organizations that pay more. So success in achieving and maintaining full employment depends to a large extent on the success in achieving sustained and real economic growth. Now let's look at the roles of fiscal, monetary, interest and exchange rate policies in achieving macroeconomic policy targets and objectives. Number one, a government uses economic policy to try to influence economic conditions, okay, with the objectives of achieving sustained growth and full employment and restricting the rate of inflation. There are two main aspects of economic policies. That's two key tools that the government uses. One is a fiscal policy and the other is monetary policy. So let's look at fiscal policy. Basically, it relates to government spending, okay, taxation and borrowing. The central government spends enormous amounts of money every year. That's why they do have budgets and they do have supplementary budgets. And the higher government spends increases the GDP of the government, okay? However, government spending has to be financed and the money is obtained from taxation and also through borrowing. So when you talk about taxation, the government plans an increase in its spending program and it will seek to finance such higher spendings, either in full or in part. And when you say in part, then which means there has to be another source. And in most cases, it's the borrowing we're talking about. So if it's just going to use taxation, then it has to go for increased taxation. And then basically the masses are going to cry. Okay, I remember when the taxation policy was contemplated, most people started saying, the government has removed subsidy, now it's coming with taxation again, you know, people are going to be rendered poor. But the government just tried to balance things, and I think they're still working. We trust that God will help them. Now, taxation is raised from a variety of sources. Both main sources of tax income are likely to be one, you either tax individuals or you tax the profits of companies. And also indirectly on what? Consumption, expenditure, and in the form of sales tax, value-added tax, and the rest of them. So those are the three ways that government could actually raise or source money via taxation: income of individuals, profits of companies, and then also on consumption, basically expenditure in the form of sales tax and value-added taxes. So let's look at the second means the government uses to raise money with regards to fiscal policy. Basically, it's called borrowing. So when the government spends, you know, more than it has raised through taxation or through taxes, it has to borrow. Okay, and in Nigeria, the main sources of borrowing for the government are one, to obtain long-term finances, that is issue bonds, government bonds through the debt management office, which is known as.
Sorry, your slides are not clear. Sorry, your slides are not clear. I can't see. Sorry.
Okay, I'm not in charge of that. So could you help us with the slide for them, please?
No, it's actually showing. It's just that, you know, it's just tiny. Yes.
Okay, I'm actually from a laptop here, so I'm not using the from Google Meet. Sorry about that, please. So as I was saying, the government could actually use two ways of fulfilling its fiscal policy mechanisms. One, taxation, the second is through borrowing. So I was actually talking about borrowing when you interrupted me. The government spends, after the government spends so much that it has raised through taxes, it now has to do with what? Fall back on borrowing. And I said they could also borrow money through the debt management office in the form of sovereign bond. This source accounts for the bulk of Nigeria's public debt, the sovereign bond. Second way of actually obtaining borrowing money is to obtain long-term finances or long-term finance, to borrow from multilateral sources such as the World Bank. Why it's multilateral is because the World Bank, the African Development Bank, is actually owned by different countries. Okay, so that's why it's called multilateral. All right, so they could actually go that route, or they could use the bilateral means. A case in point is, I think 2021. I know of the road that goes from Abuja through Akwanga to, I think, Benue, and then going to the east. It's been financed by China. Okay, so that's a typical example of a bilateral source of borrowing. Another means is to obtain short-term funding, that is by issuing short-term financial instruments known as treasury bills, which we can afford. Treasury bills are a form of short-term borrowing because the borrowed money is rapid, is repaid basically when the bills are redeemed or when they fall due, usually after 91 days. So let's continue. Now we're trying to look at the second aspect of the tools used by government to control the macroeconomics of a country. We discussed the fiscal policy. Now we're looking at the monetary policy. So basically monetary policy relates to monetary issues in the economy. In particular, one, the rate of inflation. Okay, most countries try to fight this and they put in every mechanism in place to make sure that they control their inflation. Okay, major target of the government's monetary policy is likely to be what? To control inflation. Now, another tool they use is interest rate. Changes in interest rates affect the cost of borrowing. For instance, if the CBN wants to influence how much people spend, they actually inflate or increase the lending rate to commercial banks. And then the commercial banks also cascade down to the public as they go into commercial banks to collect loans. So another tool again with regards to monetary policy is the exchange rate for the domestic currency against foreign currencies. I touched on that earlier. So changes in the exchange rate affects companies that sell goods to other countries, basically exports, okay, or buy from other suppliers overseas, basically what? Imports. For instance, if you're into import and then most of these duties and everything are so high from here, it reduces your capacity and it simply means that other people will buy cheap from you, okay, and the government is trying to discourage that. So they give some waivers to exporters so that they can have more forex coming. Now let's look at how do government influence policies, or how do government use their policies to influence the decision making in businesses. One, we say companies might try to minimize their tax liabilities, possibly by transferring business operations to low tax countries. I think there is a country, is it Cayman Islands or where they said there is no tax in that country. I wonder how they operate there. But the thing is that when such countries, even most of US companies recently, that's one of the things that Donald Trump has been trying to fight against most of these countries. So he's trying to call back countries. I think Apple used to have a factory in China, I guess, because of the large population, that is labor is cheap there. So countries like this, when governments want to influence companies, they actually lower their taxes. And you find out that even companies from other countries, organizations from other countries fly into such countries, build their companies there, operate from there, and enjoy very low tax. A case in point, I think, is Tesla of recent, because of the discovery of one of the minerals for batteries he's using. He was negotiating citing his factory in Nigeria, but I think they had a deadlock because Nigeria was talking about technology transfer. He has to teach our people what they do over there, and he doesn't want to do that. So secondly, the investment decisions by companies could be affected by tax. So we can see tax is one of the major instruments that government use to influence the decisions of companies. For example, the government might offer same tax relief for new investments, and companies will expect to receive tax allowances for capital investments. Okay, also with the new tax law, I'm aware that companies that go into agriculture will enjoy 5-year tax relief. So you don't pay tax for 5 years. And no wonder between November and December, even some of my colleagues were just registering companies under agriculture, okay? So these are the ways government operate to actually drive or encourage businesses to thrive, thereby influencing the decisions businesses make. Other tax changes can affect the rate please, the first 3 points I'm making has to do with fiscal policies. That's why you hear tax, tax, tax always. So other tax changes can affect the rate of growth in the economy. For example, an increase in the rates of income tax on individuals will reduce their spending ability. This is true. So we can see if the government really want to influence or affect our decisions, influence our decisions negatively, is just to jack up the taxes. Okay, we'll then have to spend more on transportation, more on feeding, like we've suffered last year. Okay. In the long term, businesses benefit from government control over the rate of inflation and restricted rises in prices, because real economic growth is likely to be greater. This is very true. Okay, when the government of okay, I don't want to cite this example. What I wanted citing may be off, but let me just say it. Government recently banned the production of these, like Guskulu, this sachet alcohol. That thing has been killing so many people. But I discovered MAN, that's Manufacturers Association of Nigeria, came up and were saying that this is going to affect job loss or lead to job losses and all of that. But NAFDAC also came out to say, no, for regulatory purposes, this is good. Okay, so here we say businesses benefit from government control over the rate of inflation and also restricted rises in prices. And that is why we usually in the, let me say 80s, we had what we call price control boards. Okay, and of late we've been craving for it, but it seems the government's mind is not in that direction. What does the price control board does? They make sure that there is certain ceiling for prices of commodities. Okay, so that no seller will sell above that price. Now, this will actually yield most of the benefits to those who consume whatever it is that is growing within the economy. Now, changes in interest rates affect the cost of borrowing and so also profits. Higher interest rates, I touched on this, higher interest rates on long-term finance might deter companies from making some new investments. Of course, because they know that once they come in, you know, the interest rate will eat into their profits. And this will now result in a reduction in their capital spending. Okay. And we look at changes in interest rates might also affect spending by consumers like you and I. For example, higher interest rates might reduce consumer spending and so make it more difficult for companies to sell their goods and services. During the Christmas holiday, I watched on TV, most of these people, sellers who went to the market, the patronage was low. Okay, the patronage was low. Now, because people don't have or didn't have so much in their pockets to actually buy what they need. But with the new interest rate, we hope to see tangible changes that will affect the masses positively. Now, that's as the tax law claims. Changes in exchange rates affect companies that sell goods to other countries or buy from suppliers in other countries. I've already touched on this. So these are some of the ways that government policies influence decision-making of businesses. So with this, I think we'll just wait for the questions. Sir, I'm done. Thank you very much. And group members of team group 3, please also be on standby to take questions. Thank you.
Thank you very much, sir.
Thank you,
very good presentation. Thank you for bringing life to it.
Thank you.
Sharing real life situations to your presentation. It's applaudable. It's very beautiful.
Thank you, sir.
And you've done justice to the major things, yes, but definitely I have a question, yes. But I want the class to take notes of these issues of macroeconomic policy, issues of fiscal policy, monetary policy, interest rate policy, exchange rate policy. Yes, we need to know what they entails. Yes, because these are activities that affect the economic environment of business. If the fiscal policy is favorable, the businessman and woman will be fine. So the major macroeconomic policy target of government, just as you have mentioned, government pursue macroeconomic policy target in order to ensure that what we have economic growth, we have price stability, which you've mentioned, very good. In order that we have full employment, in order that we have balance of payment equilibrium, and in order that we have a stable exchange rate. These are very good points you've mentioned. And what are the policies to achieve this macroeconomic target? When we talk about macro, we're talking about complex macroeconomic issues, such as employment issues, such as inflation and the rest. While the macro, talking about household issues. So policies to achieve macroeconomic targets, you've mentioned them, very good. We have the fiscal policy, the monetary policy, interest rate policy, we have the exchange rate policy. So all these are what we have to know. We can never tell. There can be practical questions related to each of these. So please take note of all what they've mentioned. They are very key to the syllabus. Please, they've answered the question as appropriate. So the question I want to ask is this. Just want to pick an aspect of your discussion, talking about charitable organizations. Charitable organization. Let's bring up an example that, for example, we have a charitable organization and a manufacturing company operating within the same economy. But definitely, these two organizations pursue different goals. That is very clear. Charitable organizations, they are there for humanitarian service. A manufacturing organization will be out to make profit. My question is this. Even though it's part of your work, but I'm just bringing it as a question now. How can you evaluate the financial objective of the charitable organization? That is question one. How can we evaluate the financial objective of a charitable organization? And more so, how can a charitable organization measure its achievements in terms of its stated objective? Yes, how can you measure, yes, the achievements of a charitable organization in terms of meeting up with their objective? And more so, I want to ask that, how can the macroeconomic policy of the government affect the charitable organization? This macroeconomic policy you mentioned, sir, how can they affect a charitable organization? So,
Okay.
then in summary, I will now say that, how does the government economic policy affect the decision of charitable organization and manufacturing organization? So you can respond, sir, or any other person can respond.
So the questions are just one too many, but I hope everyone in the group has also paid attention to it. Let's try and do justice to this. It's just an attempt. Let me start with the last one. How can the government's macroeconomic policy affect NGOs, not-for-profit organizations?
Yes.
Okay. Now, I know when these NGOs come, they bring funding and also equipment. Now, with regards to, I still want to hinge on the tax policy of the government. Okay. And if the government really wants to make things, that's why if the government really wants to make the environment suitable for such NGOs to thrive, one of such things they do is to what? Is to ensure that the whatever is being brought into the country is not taxed, which means there should be a waiver for it. I'm just thinking aloud, not from the books, okay? Because these are real life situations, okay? And they require application. Is an application question. So I'm trying to look at it from this standpoint that the government, the macroeconomic policies will affect such an NGOs. Let's see, I hope I'm not taking out the point. Okay.
No,
Okay.
you're doing fine. Just right now.
Yeah. When the interest rate policy is not favorable to such an NGOs, they will eventually close down because their cost of running, the fact that they didn't, they are not profit oriented doesn't mean that they are not incurring costs. Okay, so once the environment is not suitable with respect to unfair taxation policy, they might eventually pack up, and that will definitely not be good for the country, because we know how important the operations of the NGOs in this country have been, um, regardless of issues like state-sponsored terrorism, which I think you said was accused of. So I think let me just hold on to this one. The tax regime can actually affect the operations of NGOs in this country as per the macroeconomic policy.
All right, thank you very much. You know, in the course of your discussion, you made mention of various forms of macroeconomic policy. One is fiscal policy, and under fiscal policy, you talk about taxation and borrowing, right? Yes. So, one of the ways in which this policy will affect the the charitable organization is just as you've said, they will benefit tax relief. Yes, there will be benefit of tax relief. There will be grants. There will be benefit of grants. There will be benefit of subsidies. Now, how will these policies affect the manufacturing companies? The manufacturing companies will be affected by corporate taxes and government spending on infrastructure. So that is how the fiscal policy will affect both the charitable organization and the manufacturing company. Now, talking about the monetary and the interest rate policy, how will it affect the charitable organization? When we talk about monetary and interest rate policy, we're talking about the borrowing rate. Yes, the borrowing rate, the interest rate in the economy. So the point is this: for high interest rates may increase borrowing costs for both organizations, and low interest rates will encourage investment in production, especially for the manufacturing sector, and expansion of programs of charities likewise when there is low interest rates. Talking about the exchange rate policy, you know, most charitable organization depends on donations from diaspora, from outside these shores of Nigeria. Talking about using Nigeria as a case study now. So, you know, charities or charitable organizations rely on foreign donation may be affected by exchange rate policy. When the exchange rate policy is not favorable, when you receive a donation of, let's say, $2 billion, you know, when you convert it to a local currency naira, it might not really meet up with your project, the project you have at hand. So exchange rate policy will affect charitable organizations in this way, and it can also affect manufacturing companies that are involved in import and export due to exchange rate fluctuations. When there's depreciation in the value of naira and dollar is appreciating over naira, this will not augur well for manufacturing companies, because they will need to give out more naira for them to buy something that is in dollars or pounds. So I'm talking about regulatory environment as part of the economic policy. We have issues such as the charities must comply with regulations on fund management and reporting. If you have friends that work with NGO, each of those donations, they have to prepare a report, yes, to back up the funding, the spending of that fund. Yes, every project they embark on in NGO, there must be a report, pictorial evidence, reports on how the money is being used, is being utilized. So regulatory environment in terms of manufacturing companies may be affected by regulations from labor unions and the rest of them. Yes, environmental standards to keep the environment clean and the rest of it. These are regulatory environmental conditions that has to do with economic policies, and as it will affect both manufacturing organizations and charitable organizations. Yes, Madam Lucia, I see your hand up.
Okay, sir. Thank you, sir. I'm also in group three, so I will not look like it's the only one. Answer. Let's help him a bit. Like, okay, that one you said, how will NGOs evaluate financial objective, right?
Yes.
Okay, I just have this little thing to add up there. So how I feel, when you say that kind of thing, it's kind of surprising or confusing a bit because majorly the NGOs are meant to serve the public. They are not a profit-making organization. So first of
Yeah.
all, how did this NGO get their money, the financial, so they get it through grants, donations, or fundraising, even corporate sponsorships. You understand? So now that's how they get their money to run the organization. So now the way they are going to evaluate the financial is through ratios. Like you have different ratios, current ratios, and all that, and also through regulatory bodies like internal auditors and regulatory bodies that will be appointed, to also like to evaluate their financial, like to evaluate like the grants that it gets, to monitor it, and so that it can meet or achieve the objective set aside, for that period and all that. So that's what I wanted to add.
All right. All right.
Okay.
Thank you very much for that. Yes. Yeah. The financial objective of charitable organizations, we all know, yes, they are not out to make profit. Yes, their primary objective is to provide humanitarian service. Yes, and they don't generate profit. But even the fact that they don't generate profit, there's still need for proper record keeping and accountability. And even as they get funds, as they try to meet up with their goals and objectives, they always source for ways to make sure that they get fundings from international organizations to get funding. So the financial objective of charitable organization can include um, efficient use of resources. Objective is what you aim to achieve. Yes, take note of that. It's different from the other question I asked. How can you measure? So when you talk about objective as an NGO, as a charitable organization, what are your financial objectives, your financial goals? One can be, you must have a goal that every resource you have, you must efficiently use them. And you must ensure that there is what we call financial stability. There must be no time that you are short of fund. Yet, so you must always think ahead and source for fund where it is necessary. So you must have this objective, that financial stability. And you must also have an objective of accountability and transparency. Yes, accountability and transparency. So because the fact that you are getting this fund from international organization does not mean you should spend it anyhow. So you must ensure that funds are properly reported and managed to maintain donor confidence. That is why NGOs make sure that they provide reports so that the donor, we know that yes, you're actually doing the right thing, living up to expectation, or else they will seize your funding, even though presently most NGO are no longer in operation due to certain policies by the US president. Yes, so many NGOs in our country no longer get funding. Yes, all those issues, all those policies have affected some NGOs in Nigeria today. So you must also have an objective of support for program objectives. Yes, that is allocating funds to achieve social goals rather than trying to get returns. So these are some of the financial objectives you can have. Because of time, how do you measure the achievement of those objectives? How can you measure the achievement of those objectives? You can measure the achievement of those objectives by using financial indicators, just as you've mentioned in your presentation. Yes, you can use budget, variance analysis, and the rest of them. You can use liquidity ratio, as you mentioned, yes, to see if you've actually live up to expectation. You can also use what we call value for audits, value for money. Yes, that is cost effectiveness ratio, value for money. That is, you must ensure that all these are put in place. There are ways you can measure your achievements, your objective. That is using financial indicators. You can also measure your objective using non-financial indicators, such as the number of beneficiaries you've served based on the objective of your NGO, the impact assessment of your program. What are the feedback you are getting? Yes, from those that you've served, those that you've helped in one way or the other. The stakeholders, those funding you, are they satisfied with the way you use their fund? What is the report you are getting from them? That is stakeholder satisfaction. So you can arrange a form like a survey to share to those who benefit from your program. Can you rate our service? Can you rate our program? All these are non-financial parameters in which you can use to measure your objective. And also, another way you can measure your objective using non-financial parameter, non-financial parameter can be how well are you complying with the donor and regulatory requirements? How well are you in tune with the donor and regulatory requirements? These are non-financial indicators you can use to measure the performance or the attainment of the objective that is being set by the NGO or charitable organization. So thank you very much for the beautiful presentation. We quickly move to the next. I don't know. I've not seen group 4. Anybody in group 4 here? Group 4. Okay. There is nobody. Let's move to group 5. So group 4, the team lead actually mentioned that the daughter is not, the child is not feeling fine, so they are receiving medical attention. So I don't think any other person joined the group. So let's move to group 5. Let's see what they have for us. Group 5. Let me see. I just forwarded your presentation to my system now. Let's see. So for group 5, they had to talk about the sources of finance and the Islamic banking, if I'm not mistaken. Yes. So who is presenting for group 5? Anybody for group 5?
Yes.
All right, so
My name is Mr. Michael Onovo. I'm here to represent our group 5 on the topic that was given to us. And from what can be seen from the slide so far, we are starting from the first aspect of the sources of funds. Now, number one I want to mention about is that, first of all, why do companies that have been established need funds? Why do they need funds to function? Before we go into the sources of funds so far, and the reason is not far-fetched. One of the reasons why companies need funds, they need funds to be able to, meet their statutory obligations, or their maturing obligations, and so on and so forth. They also need funds to be able to, ensure that their core values are also achieved. So that being mentioned, without wasting much of our time, we are going to be looking at the sources of funds. Of course, in the sources of funds, it's divided into two. The number one aspect is that we have the short-term funds, and we also have long-term funding. On the short-term funds, we have the bank overdraft. We also have short-term bank loan, trade receivables, debt factoring, and operating lease. I will give little explanation on them. Number one has to do with the bank overdraft. Bank overdraft is a process where a company or an individual goes to the bank to, maybe it has a kind of, maybe a short-term obligations that the company or the such individual needs to meet, and probably they don't have the finances to do so. And what they can do is that they can meet any other, the bank manager or whoever is where, the deposit money bank where they have an account. Probably they have, maybe, for example, they have the sum of 500 naira in the account or maybe the sum of 200,000, and they needed up to 1 million, to be able to meet such needs. What they can do is that they will apply, and the deposit money bank will give an opportunity, an overdraft, to be able to finance. There is a kind of an overdraft of them making withdrawal above, the value or the balance in the account. So once that is done, but it's expected that, it should be fluctuating. What I mean by that is that the company that owns that account can be depositing at the same time making withdrawals in the same account, and depending on the particular period of time where they're expected, to liquidate such overdraft. I also want to make a point that an overdraft, has a limit. There is a limit. That limit, maybe, for example, that they needed a 2 million or 100, or let's say 100 million or something, let's say 500, as the case may be, the bank will put a limit to that very amount they are requesting for, and they can never exceed it, and so on and so forth. So that is all about the bank overdraft. Of course, we look at the short-term bank loan. Of course, as one of the sources of, finance, bank loan has to do with, a company having need for short-term finances to meet their obligations, short-term obligations like paying of salaries, buying of goods, and so on and so forth. What they can do is that they go to the bank, apply for loan. Of course, short-term bank loan comes with an interest rate. An interest rate, is expected to apply, and with a specific period of time. And what that means is that whatever that the company, once the loan has been applied for, of course, and granted, what is expected is that they are expected to work according to the loan repayment schedule that have been given to them, and they are to ensure that they pay as at when due. So that is all about that. Then looking at the trade receivable, of course, the aspect of the trade receivable, on the aspect of the trade receivable, the company also, for example, people going a company maybe that demanded for goods or something, and probably they needed such such goods to be able to meet one or two things. So trade receivable is also one of the sources of fund that a company can also employ to also get their needed funds met. They also go to debt financing. Network is taking me off. Oh my God.
Hello, is it okay now? It's like, are you following? Can you see my slide, sir?
Network is bad. Me, I can't see slides.
I think he's out. If the network has pulled him out.
Michael just left. Network has pulled him out.
Okay. What did I should continue? Madam Roots.
Okay, hello, sir.
Yes, I'm with you.
Okay, let me continue from where he stopped. Okay, he stopped at debt factoring. Okay, when we talk about debt factoring, is one aspect of source of finance for an organization whereby, let's say, for example, a company have an invoice where they need to collect their own funds from customers, then and they need money at that moment. They can issue the invoice to this another organization, which is the factoring company, for them in, let me say, in a discount amount to collect their money. They will issue, like, give the company their invoice, then collect it at a discount amount to get their own money back. Then the next one is operating lease. Then we'll go to long-term sources of finance. For long-term sources of finance, for financing long current assets and something working capital as well, they are, one of them is equity finance, debt finance, finance lease, venture capital. Then for equity finance, this is the finance provided by the owners of the organization, e.g., the shareholders. And this can be derived from retained earnings, internal source. Internal source. Then the second one, issuing new shares, like fresh issue or existing share. Then the second one, under equity finance, we have retained earnings. This is when a company make profits. They retain some in the business and pay some as dividends to their shareholders. Then that one retain is reinvest into the business to contribute towards further growth of the organization or the profit. Then the benefits include no issue cost like that of share issue. No approval is required for retention of earnings. It's already available on time because it's part of the profit of the organization. It's just for them to divide it and give parts to their shareholder as their dividends and keep others for the growth of the organization, the growth of the business. Then the limitation include the company might earn large profits up to the level of retaining some in the business.
Then the second one, profit might be constrained because of some dividend policy constraint. Then the next one is issue of share. For private company cannot offer their share for sales to the public because their shares are not traded. That is for private companies in the NLC. Investors avoid them because their shares might be difficult to value. Then the second one, difficult to sell when shareholders need cash because it's not a traded company. Then for public company, most of them trade their shares in the stock exchange market. Issuing new share for cash and also considering selling and buying existing share, many investors prefer public, which is public organization, public companies, because their shares can be valued at current market price and can be sold at secondary market. Method of issuing new share for cash. Public offer. Public offer is an offer to the public, to the general public. While placing, we have like method of issuing new share. We have one, public offer. Public offer is an offer to, or like invitation to general public, while placing to a relevant small number of selected investors, then right issue to existing shareholders. Then okay, we have offer for sales by tender. In a normal public offer, the issue price for the new share is fixed. With an offer by tender in a normal public offer, the issue price for the new shares is fixed. With an offer by tender, where investors are invited to apply for purchase any amount of share at the price of their own choice. Then we are still on the rights issue. So to move fast, I think we should go to sorry. Hello, Mr. Tokwe, I'm not seeing your slide. Can you hear me? Hello?
Hope you can see it now.
Yes. I can see it now. It's going off and on, and my system is down.
Yes. Can you see it now? Can you see it now?
Okay. Yes. We move to underwriting of new share issue. Large new issue of shares. Large new issue of share for cash are usually underwritten. This means a group of investment institutions, underwriters, agrees to buy up to a maximum stated quantity of the new shares at the issue price if the shares are not purchased by other investors in the share issues. They do this for an underwriting commission. The advantage is that there will be no unsold shares to issue, and the company is certain to arising the expected amount of cash. A major advantage is that payment of and underwriting commission may be high. But both public offers and rights issues are usually underwritten. However, if a company does not want to pay to underwriting, if a company does not want to pay to underwrite a rights issue, it might offer a new share at a very low price compared to the market price of the existing share. This is called deep discounts issue. In Nigeria, every public offer must be 80% underwritten by an issuing house. Then right issue. An issue for cash offer to existing shareholders is proportional to the current shareholding. The following are to be considered. One, issue price. Issue price, it is issued below the market price but above the nominal price of existing share so that the shareholder can be encouraged to subscribe to them. This means an issue price is always lower than the existing market price to encourage others or the general public to buy more shares. Then we have the theoretical S-right price. The theoretical S-right price, when a company announces a right issue, the market price for the existing share just before the new issue takes place is called cum right. Cum right price, which simply means with the price, it means current price, current shares. Cum right and the share price must be weighted to have the theoretical S-right price. I guess we all know about what is cum right, theoretical S-right price. In the previous class, while we were doing cost of capital, Mr. Tokwe threw more light on that, especially that cum right. Okay, we go to shareholders' choice on rights issue. They can take off the rights and buy the new share. Then the second one, they can re-announce the rights by selling them in the market. Hello, can you help me move it up? Then the third one, they can take some and renounce some. Then the fourth one, they can do nothing. So we move to debt capital. Debt capital is used to describe a finance where the borrower receives capital from a lender, pay interest on the outstanding balance, and subsequently repay back the principal amount at maturity. Then form of debt, we have traded debt and non-traded debt. The traded debt is from the stock market, while the non-traded debt is borrowed from bank because it's not traded in the stock market. A debt, whether secured or not, usually comes with a covenant including an undertaking to pay both capital and interest. That's debt, that's secured debt. Then terms or duration of debt. Then we have long-term debt, middle term, then short-term. Then for long-term debt obtained from issuing bonds and usually take a long period, probably above 5 years. Example, debenture and loan stock. Then the second one, medium term. It could be bank loan and takes up to 5 years, as the case may be. Then short-term loan. The short-term debt, they are bank overdrafts and money market instruments like commercial paper, treasury bill, etc. Traded debts can be redeemable, irredeemable, and convertible. Then access to bond market. Private companies are prohibited by law from offering bonds to the general public. If they want to borrow, they must seek a bank loan or find investors who are willing to invest in their business. Large public companies can raise capital by strategic financial management. By issuing bonds in the international market, that's for public companies in the international bond market, and they usually pay to their to have their bonds given a credit rate by one or more credit agencies. Then the advantage of debt financing to the lender. Lending money out or purchasing bond is safer than buying share in the company because of the following. Loan is usually redeemable, so the capital is coming back. Interest have to be paid back by borrowers irrespective of their performance. Then the next one, debt might be large legally secure on assets of the company. Then the next one, lender rank higher than equities holder in the case of liquidation. So go to convertible bonds. These are bonds that give their holders right, that give their holders right, but not the obligation at a specific future date to convert their bond into a specific quantity of number of new equity share. If the bondholder choose to exercise the right, they will become shareholder in the company, but will surrender their bond. Then the next one, if the bondholder decides not to convert, they will redeem at maturity date. Then bonds with equity warrants. Share warrants are a form of option giving the holders the right but not obligation to subscribe for a specific quantity of number shares in the company at a future date. So we move to preference share. Preference shares, they are near debt because they have characteristics of debt equity, but they are neither debt nor equity. Then the basic features of preference share. Fixed rate of annual dividend. They have a fixed rate of annual dividend. Then preference dividend paid out of profit after tax. Holders rank ahead of equity holders upon liquidation. Equity holders, they are the shareholders, not the assets. Non-current liability rather than under equity and dividend paid as a result of them are reported in interest costs in the income statement. However, if preference dividends are classified as interest costs, they do not attract tax relief. Classes of preference share. We have redeemable and irredeemable preference share, cumulative and non-cumulative preference share, convertible and non-convertible preference share, participating and non-participating preference share. So we move to Islamic sources of finance. Islamic finance rests on the application of Sharia. Sharia law is derived from the Quran and the teaching of Muhammad Muslims believe that Sharia law shows the path to be followed or to be followed as ordained by Allah. It covers all aspects of life, and Muslims believe that following this path will lead to physical and spiritual well-being. Okay, now concept of riba. Riba is also known as interest. Islamic banks are allowed to obtain their earnings through profit sharing investment or fee-based return. If a loan is given for business purposes, the lender should take part in the risk. This usually involves the lender buying the assets and then allowing the customer to use the assets for a free. Riba is defined as the excess paid by the borrower over the original capital borrowed. That is the equivalent of interest on a loan. Okay. The next one, we move to Islamic financial instruments. One of the Islamic financial instruments, the following Islamic financial instruments provide Sharia compliance finance. Often the cash flow from the techniques might be the same as they would have been under standard Western practice. However, the key difference is that the rate of return is based on the assets transaction and not based on the interest on money loan. One of the instruments we have Murabaha. The Murabaha is a form of trade credit for asset acquisition that avoid the payment of interest. The bank buys the asset and then sell it to the customer on a different basis at a price that includes an agreed makeup of profit. Payment can be made by instrumental, but the makeup is fixed in advance and can be increased even if there is a delay in payment. Then the second one is Ijara. Ijara is the equivalent of lease finance. It is defined as when the use of the underlying asset or service is transferred for consideration. Under the concept, the bank makes available to the customer the use of assets or equipment such as plants, office automation, or motor vehicle for a fixed period and price. Some of the specification of the Ijara contract, including the use of the lease asset, must be specified in the contract. The lessor, which is the bank, is responsible for the major maintenance of the underlying assets, which is the ownership cost. The lessee is held for maintenance, for maintaining the assets in good shape. Then the third one is Mudaraba. The bank provides capital and the customer provides expertise to invest in the project. Profits generally are distributed according in the predetermined ratio, but cannot be guaranteed. The bank does not participate in the management of business. This is like bank providing equity finance. The project might make a loss. In this case, the bank loses out. The company cannot be made to compensate the bank for this loss, and they will be contrarily to the mature sharing of risk. Then the next one is Musharaka. Musharaka, this is the relationship between two or more parties who contribute capital to a business and divide the net profit or loss. It is most closely aligned with the concept of venture capital. All providers of capital are entitled to participate in management, but are not required to do so. Then the profit is distributed among the partnership in pro-agreed ratio, while the loss is borne by each partner strictly in proportion to their respective capital contribution. Then the fifth one is sukuk, which is the last one. Sukuk, this is debt finance, but Islamic bond cannot bear interest. Sukuk holders must have an ownership interest in the asset which are being financed. The Sukuk holder return for providing finance in a share of the income generated by the asset. Modern Sukuk share many features with Western securitization. There are many different types of Sukuk, which include Ijara Sukuk, Mudaraba Sukuk, Murabaha Sukuk. So I end my presentation here. Thank you all.
All right, thank you very much for that.
Thank you.
Yes, I've been asked to talk about sources of finance. Sources of finance. Yes, the finance is the live wire of any business. So financing of companies' activities can be classified into diverse ways. And the essence of why you need finance in an organization is to see how you support your non-current assets, is to see how you get money to run your working capital, that is your day-to-day operations, is to see how you get money for business expansion, is to see how you get money for growth, research, and development. So for you to meet up with all these obligations, you need finance to make sure they are achievable. So when a company does not have sufficient capital to finance the acquisition of non-current assets or the amount required to run the day-to-day operation of the business, such a company may need to source for funds to be able to achieve its target goal. So selecting appropriate source of finance by a company is necessary in order to avoid funds mismatch. Yes, what do I mean by funds mismatch? You cannot use short-term borrowing to finance long-term assets, to finance capital projects. So you use short-term borrowing to finance short-term day-to-day operation of a business. So there are various sources of finance, as we've mentioned. We have short-term sources of finance, we have long-term sources of finance, we have Islamic financing, and under the short-term sources of finance can have issues such as accruals, trade credit, bank credit, factoring services, commercial papers, bankers acceptance, bill discounting, invoice discounting, and so on and so forth. And can have issues such as lease finance, hire purchase. Then under the long-term sources of finance, have issues such as debts, preference shares, equity, and so on and so forth. Islamic finance, you can have things like Murabaha, Ijara, Sukuk, Mudaraba, Musharaka, and so on and so forth. So all these are sources of finance, to organizations. Well, certain terms here might look new to us, for some of us that are not of an accounting background. Things like Islamic finance, another word for Islamic interest-free banking, because according to the Quran, yes, it is expected that you should be able to get money without interest on it, because Islamic finance is seen as a form of ethical investing. It's seen as a way of lending money to people ethically based on Islamic laws, which is Sharia. So Islamic finance is equity based, that is seeing everybody as same, is asset backed, and it supports the sustainable environmental condition. So that is Islamic finance for you. One thing with Islamic finance is that it promotes risk sharing and it connects financial sector with the real economy. Now, some of the examples of banks that operate that, we have things like Jaiz Bank, even though in the real sense, in the last diet, somebody made a presentation and she narrated her experience with the bank. Yes. So based on what is expected to operate uh, interest-free transactions. So the objective of Islamic finance is that to be true to the Sharia principle of equity and justice, and should be free from what unjust enrichment. You don't play on people to enrich yourself. Yes, and this must be based on true consent of all parties. By the time you want to get source of finance through this means, everybody must be in the know. So you must, as you study this topic, you must be able to interpret what murabaha is, what ijara is, what sukuk is, what mudaraba is, what musharaka is. Because it is my expectation that in one of the exams, they will ask a question on this. Yeah, so do well to read these things and know them and have them at your fingertip. It will help you one day. It can be in an interview, it might not be even in the exams. So it will help you in a great way. Yes, because the class is becoming too long and I need to go also. So I'll just ask one question. You know, sometimes when you start presentations in school, it's the first set of people that that are always that always get serious questions. But by the time the class is going, even the facilitator will get tired and can just even tell you to take a bow and go. So let's just ask a simple question and see how far we can go. So the question I want to ask is, what do you think are the major differences between Islamic finance and conventional business finance? Yes, what are the differences between Islamic finance and conventional business finance? It's a very simple one.
Okay. First of all, I want to begin by apologizing to the house for the breaking transmission because it's a network issue. So concerning your question, sir, the major difference between the conventional bank and Islamic bank has to do with interest. The Islamic bank does not accept interest. Okay, it does not accept interest, and why that of the conventional bank accepts interest. So that is one of the major aspects of the Islamic bank. Thank you.
All right. So what do you call interest in Islamic finance?
Riba.
Fine, riba. So I want us to get used to those terms. Riba, riba, riba. Yes, just as you've said, in Islamic finance, charging or paying interest is strictly prohibited. Yes, so return on investment must be derived from profit sharing. Yes, or asset-backed transactions. While in conventional finance, interest is the primary means of generating returns on loans and deposits. So borrowers pay interest to lenders regardless of the business outcome. So that is one thing with the conventional banking. So, and also in Islamic finance, returns are linked to what actual business performance. So if the project succeed, both investor and entrepreneur share profit. But if it fails, losses are shared according to what? To pre-agreed ratio. So there are so many things attached to this until where you go into it practically to get a source of finance through Islamic banking, based on the various documents that will be issued to you, then you will see the various conditions that will be attached to it. Now, the major thing is in what we've done is, please do well to read, at least read these like 2 to 3 times, yes, so that you have them at your word bank, so that anytime you see question on them, you will just have a reflection and be able to write something down very well. Yes, on all these we've talked about, the aspects group 5 didn't talk about, or group 4. I'll talk about it subsequently. I'll discuss that subsequently. So I'll forward all the materials, all the slides to the group, or everybody, you can send your slide to the group. Yes, your group slide to the group. Let everybody have access to it. And I will check for my notes on these aspects and forward to the group likewise. So I want to appreciate everybody for keying into this initiative, for giving out your time to put forth something and present. Pray this will not be an exercise in futility. It will be a fruitful one. Yes, it will be a fruitful one.
Amen. Thank you, sir.
Yes,
Thank
thank you.
Thank you, sir.
Thank you for the initiative.
Yes,
Thank you,
God.
sir. We are grateful.
Thank you, sir.
Yes,
Have
and I
a
think
good
everybody
day.
yes, we've learned 1 or 2 things, and to be much more because
Thank you for
I
the
watched the
initiative.
video for
Thank
group
you,
2
sir.
presentation.
Thank
Thank
you.
you, everyone.
Thank you, sir.